Saw the trading floor, took the market by storm. Stocks rising high, and profits were born from Wall Street to the Mississippi shore. Best stock trader, that's for sure. Driving in style with the top rolled down, cruising in my Corolla, the talk of the town. Stocks climbing up, never going down. I'm the king of the market, wearing the crown. Thickest thighs, you won't believe your eyes. Moving on the dance floor, mesmerized. Swinging and swaying to the rhythm tonight, like a stock chart rising, taking flight. With the top rolled down, cruising in my Corolla, the talk of the town. Stocks climbing up, never going down. I'm the king of the market, wearing the crown. I'm the king of the market, wearing the crown.
Hello, and welcome back to a specialty episode of the Matt Kohrs Show. Folks, I cannot articulate how excited I am to bring you this. Not only is the market going crazy right now, heading into a holiday weekend, just got the FOMC minutes. We know that this is a volatility OPEX, and the cherry on top of this entire crazy situation is Nvidia is about to report their earnings. In just over an hour, we're going to find out how they did, and then a little bit after that, obviously, the company is going to have their earnings call. And with so much insanity, so much movement, obviously, there's a lot of questions, a lot of question marks on how to proceed in the current situation. And obviously, nothing is gospel. Nothing can possibly be guaranteed, but diving into the data, putting on our big, thick glasses, we could get a little bit nerdy and feel a little bit more comfortable with how things might be potentially playing out. So instead of just ripping it and firing it from the hip, I'm very, very excited on this particular stream, the specialty stream, to be talking with the people from Spot Gamma. And I'm saying literal options experts to not only break down what they're seeing, but really offer a little bit of color and context to this whole situation. So thank you, folks. I do appreciate you joining me today. I know this is kind of a one-off specialty thing. This isn't the normal time. So the fact that you're taking time out of your schedule to join me, listen to Brent from Spot Gamma, it really does mean the world. Now, just so you guys all know, I want to show you a couple things just so everyone feels a little bit more comfortable with the situation to understand what we're talking about. So the SPY was literally doing nothing today. And then a little bit after doing nothing, we got some treasury reports where, yeah, the high yield came in lower, but the bid to cover ratio, not so good. And then when you had some FOMC meeting minutes that said, hey, yeah, rates higher for longer. I don't know why the market reacted in such a negative way, but they were surprised as if they didn't know we were in an inflationary period. So the SPY puked, the Qs puked, the dollar started to rip, but obviously the belle of the ball is Nvidia. Now, why is this so important? Well, it's a major semiconductor play. You could safely argue that the S&P 500 and the NASDAQ have been pushing this year because of these AI plays, which brings us to the current situation of the entire global economy. And everyone wants to know, will Nvidia be able to keep it up on its back? That is the golden question that we're going to be here to answer, but not really the prediction I want to clarify of a beat or not, of just maybe a unique way to look at the situation to take advantage of some potential opportunity. That's exactly what we're going to be getting into. But just so you guys have a little bit more of a mental framework of the numbers to look for when the market actually closes, Nvidia Revenue, we're looking at year over year 24.5 billion, EPS somewhere in the low to mid fives, and we're looking at roughly an implied one-day move about in the realm of 10%. Just to put that out on everyone's radar. I also just wouldn't be doing my job if I didn't let you know that going into this, some politicians are selling their Nvidia. So Representative Pete Sessions just sold $100,000 worth of Nvidia prior to the earnings. Now, does he know something we don't know? I have no clue, but I just think it's important for me to share this with all of you. And now let's get into the fun stuff. Let's talk about spot gamma. Let's talk about what in the world is happening with options. And also, just so you know, right now there's about 2 days left. 2 days and a little bit of change heading into the holiday weekend where spot gamma, which happens to be by far, like it's not even close, by far my favorite options analytics tool. Usually it's $250 a month, which I respect. Folks, yes, that is not the easiest thing to pay, but when you're going to realize how powerful it is, and when you're going to realize that they're currently offering an 80% off deal, I think it's something that everyone listening to this should consider. Now, with that being said, we do have the expert with us to chat about everything going on. So with that being said, let me switch it over. Brent, can you hear me all right? Yes. Audience, are you good? Are we all coming through? Is our audience, is the audio balanced well? Is it not balanced well? What's going on? Because I don't want you guys to miss a single word that Brent has to say. All right, let's get this going. Voice crack. So I don't think that's really a voice issue. That's probably just something more so for me, more of a personal attack. But hey, we're going to rock with it. We are going to absolutely rock with it. Brent, I understand you're a very busy man. You're doing all this travel. You have a lot going on. Hey, options are hot right now. So the fact that you're taking time out of your day to speak with me, the audience, I truly appreciate it. So with all of that being said, I think we could get right into the craziness of the situation. Nvidia. I want to just bring it right over and let's just get right into the point where I could do this and then I will happily share my screen with you. The audience can see it right now. I just want to make sure we can see it and I'll let you kind of direct me on. And I think the golden question here is just to confirm, you can see my screen right now?
Yeah.
Okay. Just to you, an options expert, a co-founder of right here, Spot Gamma, you know something big's about to go down. Walk me through your process. You just logged into Spot Gamma. What are you doing right now?
Yeah, so first, let me address the sell-off this afternoon that we just saw for FOMC minutes because it sets the stage for Nvidia and stuff. The 0DT straddle, so what's the price of the straddle. So buy the call, buy the put at the market open today for today's expiration was just $17. It was only $17 yesterday. So if you divide that $17 by the price of the S&P 500, you get like 30, 35 basis points. That's unbelievably low. That's essentially saying that the market is saying that the S&P is not going to move more than 17 handles up and down over the course of the day. When we had FOMC minutes coming up, and even though Nvidia earnings is after the bell, there's a couple of reasons that volatility should start to move. So expectations for today were that literally nothing was going to happen. So what happens is when you get FOMC minutes that just gives you like a little bit of something happening, suddenly goes, uh-oh, I was short the straddle at like say 17 or like an implied vol of like 9. And then suddenly I'm totally mispriced. I got to scramble and cover, right?
Gotcha.
So it takes this little move that shouldn't be a big deal. And then suddenly we get this jump, right? And now what we're seeing is we got the jump, right? Because you're forced to overreact. If markets are about expectations, if you're expecting nothing and you get like a little something, like, oh crap, I got to react. Excuse me.
Interesting.
So, now the S&P was trading on 5280. We're bouncing back now. We're about 5300. 5300 is this really big level. If you look at what we say the size of gamma by strikes, we think large hedging flows are associated with these levels that have big gamma, and that's kind of what you can use as support or resistance. The two biggest levels on the board, 5300 and SPY 530. So that's roughly 5320. Now, if you look at like a 5-day chart of the S&P, you just see we're ping-ponging back and forth. So why do I get into all this? Because the market was pricing in no volatility. We've been stuck at what I call fair value, which is basically 5300 to 5320. And now we're finally going to get Nvidia earnings tonight. And why does Nvidia earnings matter? Is because the chip sector, obviously, as you mentioned before, is the leading sort of sector It's where the innovation is. It's kind of what the hope of the country sort of rests on in a lot of ways. And those stocks are the biggest component now of a lot of the indices, particularly NASDAQ, et cetera, if you look at the semis writ large. So implied vol, when you look at it for Nvidia, it's much lower. We put a couple of these charts on Twitter so you can get a reference of them. If you go to @SpotGam on Twitter, you can check it out. But we compared the current skew, which is basically 1 month implied volatility of 1 options prices. We compare them. That's the green line is the teal line. You can compare those implied vols versus where we were into February earnings, or Nvidia had a huge conference in the middle of March as well, right? People were really bulled up for that. And the expectations for those two events were an order of magnitude higher than where they are today. So even though the implied volatility, as you just mentioned, the implied move is fairly high for Nvidia, the bullish expectations are not really there right now. And that's leading to much lower relative implied vol than we've seen in the past. Now, Druckenmiller dumped his shares. You mentioned some politicians and things like that. My takeaway from this implied volatility pricing is that Nvidia could have a much better likelihood of an upside surprise in a bigger kind of like reaction now to the market because the expectations are pretty low. They're just not as big as what we've seen in the past.
Gotcha.
And so I think that could lead to a general move up in the market. Just generally speaking, Nvidia is going to release from this 5,300 level in the S&P 500. Volatility can come down if Nvidia earnings are fine. You're going to see the VIX really start to sink. That's going to come into a 3-day weekend, Memorial Day weekend, where people are likely not want to hold a lot of long vol over a 3-day weekend. And that gives us the opportunity to have a pretty decent move up, I think, to new highs. And that's kind of what we were mentioning this morning. And so that's the default way that I'm looking. We've talked about the way to express this. And sorry for going on so much here, Matt. I'm sure you want to interject here in a second, but we talked about in our founders that we think the way to play this is SMH call. SMH is the semiconductor ETF. Its implied vols are even lower. And generally speaking, when you go into an event, right, and you own options into an event, implied volatility automatically drops, right? So that is a tax on whatever option position you are long. Okay. And so for that reason, we don't want to play Nvidia options here. We want to play SMH because we think that the event tax from Nvidia coming out on the implied volatility of SMH is that much lower because it's not a direct bet on Nvidia. Nvidia is 20% of that ETF. I think I think SMH will move up very well. If the market broadly moves up, if Nvidia is positive, and SMH should react well as in kind. And so that's the way that we're choosing to express this. And the reason we're saying calls is it's fixed risk, right? If Nvidia reactions aren't good or the market large doesn't react well to this, okay, you got defined risk. We're looking at 1 month SMH options. And if we're wrong and the market goes down, great. We lose a couple of bucks on the calls, but we bought them at a very low implied vol. And, that's the way that we're looking at this thing. So sorry for going on for a while. I want to set the stage and let you know how we're looking at this.
No, I appreciate that. And I think there's some things there that are definitely worthwhile to impact. So folks, for those of you who are not watching this as a recording in real time, the market's bouncing back. It seems as if there was some sort of overreaction, not only to the craziness of the lack of volatility that quickly expanded, and then potentially not NLPs, natural language processing, not understanding the FOMC minutes, but there is a bounce back. I just want everyone to be mindful of that, especially if you're degenerately slinging some sort of position. On the right side of your screen, you see Nvidia. So it actually was not far away from an all-time high today. Same thing, kind of peaked a little bit. SMH, that is the ETF. Think of that as a basket of stocks, and a lot of other AI plays are in it. So think about SMH tracking some sort of percentage of Nvidia, AMD, Intel, Micron, Broadcom. It's that whole group. It's how you can track the sector. And that is what the Spot Gamma team is referring to. We're like, hang on, we like that a little bit better. And I don't want to put words in your mouth, but you're saying you like it better because of the, I guess, proportionate over or under pricing of premium right now. You're saying that you think SMH, if you were bullish going for calls, is less overpriced than Nvidia. Am I repeating that back properly?
That's exactly right. So generally what happens, implied volatility is always elevated into earnings. And very, 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 like 90% of the time, after earnings, implied volatility goes down. Even if the stock rips or the stock drops a lot, implied volatility comes down. Anytime implied volatility comes down, that is a tax on a long options position. So if you own a call before earnings, as soon as earnings comes out, implied vol drops, and that call option you own is going to pay a tax. And you're crossing your fingers that the stock moves enough to cover that tax that you're paying. And we talked about this in the last Nvidia into the conference recently. We did a post about this in the GameStop options recently, where that implied volatility tax around earnings is massive. So how do we avoid that tax? Well, if you go to SMH, the tax is relatively smaller because it's not a direct bet on Nvidia. However, if Nvidia earnings are good and Nvidia goes up, well, SMH is 20% Nvidia, and AMD and all the other stocks you just mentioned, the other semi-chip sector stocks, are going to rally off Nvidia earnings, right? Maybe Intel will stay out of it because it's the thing stinks. But that's the point, right? Let's find the sort of indirect way to play this and express our view here. And I also think when he talked about the really low implied volatility in the S&P 500, kind of like what I would say is what looks like an overreaction to FOMC minutes. If Nvidia earnings are good and we do get a really good pop, I got to fact check this one, but the last time the S&P was up 2% intraday was in February Nvidia earnings last time. And Nvidia earnings last time were a blowout. I just bring that up because Nvidia is big enough that it can invoke stock S&P market vol. And we could show that if you go to the S&P 500, if you type SPX there and look at the term structure, you can see that the S&P term structure has a kink in it because of Nvidia earnings tonight. And that rarely happens.
Oh, right there. That's funny.
Right. If you look out, and this is after FOMC minutes, with whatever the reaction you think is, look how low those implied vols are. And these are what we call the at the money implied vols. They're at the bottom of that cone. That cone is the 90-day, 90th to 10th percentile range for at the money implied vol in the S&P. So what does it tell you that it's at the very bottom of that cone? It means that nobody cares about risk in the future. So say what you want about FOMC minutes. Maybe it's got to be digested. I don't know. My bet is that, look, it's a 3-day weekend coming up. So as long as Nvidia is like okay or good, then the market's going to breathe a sigh of relief, and that probably buoys us back up, right? Probably lifts us back up.
Okay, so the at the money options are literally telling us, okay, in the very short term, as in today, tomorrow, the next day, slight elevation, but by the time we get to the conclusion of this month, most likely volatility is going to get crushed.
Yeah, and why are the implied vols elevated for tomorrow? It's because the S&P can't react to earnings, Nvidia earnings, because they're after the bell, right? So the move that has to get priced in is what is the impact for tomorrow? And so that's why implied vol is elevated for tomorrow. Then you got the 3-day weekend, which is why there's a funky kind of gap down. And then for next week into the end of the month, and really you look out until the election, implied vol is dead flat, right? And the VIX this morning, I think, broke 12 for the first time. I just think that this is a market that it doesn't care. Like it's just not worried about whatever risk you want to throw at it until it gets clubbed over the head with something, like missiles flying through the air, rates actually going materially higher. It's like the specter of risk just doesn't matter enough. It actually needs the risk to manifest in order for people to react.
That makes sense. But then for the viewers listening, to assign some numbers to it in terms of the relative cheap or expensive. So I'm looking at Nvidia on the fixed strike matrix, obviously for this Friday, because that's the closest expiration. So the fact that it's green is telling me it's juiced. And if I look at roughly at the money, Nvidia is trading at 940. So it says 138%. So that means you're definitely paying a premium, whether for calls or for puts for this Friday. And just to add numbers, you're saying that SMH is a bit cheaper, and I'm seeing 67%. So it's still green though, which means it sounds like it's on a relative basis a bit more expensive, just not as expensive as you're seeing in Nvidia.
And those are the zero DT. I mean, those are I call them the zero DTs. They're the next expiration options, right? Those expire in 2 days. And so that's why the vol is extremely jacked for those periods. And I like to say, hey, let's focus on a month out, right? Because I think we're getting a good move. And if you click on the volatility skew tab there, we'll show you how statistically whether the options are cheap or expensive. If you look at that curve there, you can see where SMH is, SMH you have up there, right? So it's a little small. That green line is at the bottom of that cone. That green line is 1 month skew. So what is the implied volatility of all the options that expire in 1 month? we're at the bottom of that cone, even though this huge earnings event is taking place. So if you're saying, hey, Brent, maybe I'm right about Nvidia going up and SMH going up. Maybe I'm wrong, but I just don't want to pay too much for that bet, right? That's the first order priority that we want to avoid when we're trading options. Like, I don't want to pay too much. No one wants to be the sucker, right? Maybe my bet is going to be wrong, but I don't want to pay too much for that bet. The fact that we're at the bottom of that range tells me that, look, these options are cheap relative to the last 90 days. And there was a lot of volatility in the last 90 days. Obviously, we had a huge rip into April. April sold off a lot. But there's this catalyst that we know is coming, and we could just say relative to these last 3 months, we're making a cheap bet. And that's up or down, right? If you want to bet that I'm wrong and Nvidia is going to be terrible and the market's going to fall apart, well, the puts are fairly cheap as well in the same order that calls are.
Gotcha. So would it be accurate to say that if we have someone listening right now and they're like, hang on, I'm feeling directionally biased, whether they want to buy calls or buy puts, in your opinion, in terms of overpaying or underpaying, you would prefer buying calls or buying puts on SMH. But if we had someone listening who's like, you know what, I actually want to sell premium, you would actually do that on Nvidia instead because it's more expensive.
100% right.
Okay.
So yeah, that's exactly right. And I would say, if you look at Nvidia in this case versus the previous two events, the implied vol is a lot lower. So I don't love that there's all this extra juice there to sell, right? Sometimes you look at something and go like, this is just so attractive, I gotta like jump in here. Like GameStop options, they were so crazy elevated. The implied vol are 300-400%.
Mm-hmm.
And when you start to get implied vol that is that heavy, I think, or large or high, it starts to work against the move. And this starts to tie into like dealer hedging flows and the mechanics and things like that. But if you just think about probabilities, the higher the implied vol is, the more you need sustained moves of increasing magnitude for those options to pay off. So what do I mean by that? If you have this rule, there's a rule called the rule of 16. If you divide the current implied vol by 16, that tells you what the one-day move is being priced in the given stock or that you're looking at. So when you're paying, GameStop was trading at 300% implied vol, you're talking, 20% moves. You're talking about these massive moves that have to take place. And then the stock has to sustain that movement in order for those options to pay off, right? So you're going to go into Nvidia now, where the options are kind of average based on that range, as you can see there. They're in the middle of that cone. That tells me there's not, relative to history, there's not a big premium at all. There's also not much of what we call a call skew. A call skew is when out of the money options have a much higher price relative to at the money. So it's literally, you can see how the top of that shaded cone goes up like a ramp.
Yeah.
You see how flat it is now, right? That's a sign that call demand is not that good. So if you think about everyone being very excited about Nvidia and having to buy calls so they get, exposure to this upside, that doesn't really exist here either. So you look at this and you go, I want to sell call spreads in the event. Well, the calls don't look relatively that elevated. Implied vol it generally doesn't seem that elevated because we're in the middle of that cone. It just doesn't jump out as me as like this high probability kind of like jumping out, great opportunity here.
Gotcha. So with that though, this is still based on like a 30-day expectation. Is there
90,
a way
90 days.
like, okay, but is there a way, I guess, in terms of people playing this Fridays? Because like then when I come to the term structure, I think, oh, okay, that's an interesting crush. And then when I come to just looking at for 524, like these ones seem to be expensive.
Yeah. So here's a cool way to do it. Hit term structure there. And then in the top right, there's a little 3-bar icon there. And click forward implied vol. Top left there. Slide that thing on.
Forward.
Cool.
IV adjusted. This one?
All right. Yeah. So you see where that line is down there?
Yes.
The light line? That's where we think implied vol should go once the event is out. So that's your implied vol crush. And so what do you do with that? You could take whatever option you want to trade, go to like a Black-Scholes calculator. If you could Google Black-Scholes calculator or your broker's platform may have it. Say I want to sell this call as an example, and you put in the implied vol of where you think we're going to go with the forward implied vol. You can see that gap down.
Mm-hmm.
So compare whatever the forward implied vol is today versus with the real-time implied vols, which is the bright green line. And then at the bottom you have the forward implied vol. So in your Black-Scholes calculator, see what the current options price is, what the current implied vol is, and then plug in what we think the forward implied vol is instead. And you'll see the price of the option drop.
Just drop. Gotcha.
And that's what your best case scenario is right after the move comes out. And so that
Interesting.
gives you an idea of, hey, if I sell this and vol comes down, how much do I make if vol collapses, right? And you go, okay, great. Maybe this call I sold is going to make 10% or 50% or whatever it may be. And then you can also kind of figure out, well, how much of a stock move, does this protect me against, right? Because if you sell vol and vol goes down, but the stock goes up 10%, you can still lose on selling your call, obviously, right? So by playing with the implied vol, it's a great way in these calculators to set up an estimate of what your risk parameters are.
I like it. It's good. Right here, this is interesting because we're talking the end of this month, 5/31, May 31st. The expectation is right now the IV, the implied volatility, is sitting at 75. And I mean, damn near going to get cut in half after it.
Yep.
Looks like we're dropping to 40, which,
Yeah.
of course, if you're on the right side of the prediction, that's good if you're selling premium. But then even if you're wrong, just the fact that you're losing so much intrinsic value gives you a little bit more of a buffer. Very, very interesting.
And the straight way to play this, or one of the straight ways, is a counter spread. So you sell the short-term option, generally not the option that expires in 2 days because I think it's too noisy, but you can sell like next Fridays and then buy something where the difference between that term structure line and that forward implied vol line is smaller. So like a
Okay.
1 month or 6 week
Yeah.
option, right? And so the idea is that the short-term option gets crushed because implied vol drops way more than the implied vol drops for that longer dated option. Does that make sense?
Yes. Gotcha. So it looks like we're looking at IV and percentages. Is there a way, once again, in a shorter time frame to look at the, I guess, nominal expectation of the move? Because right now, like one of the most popular things, people are like, hey, I think Nvidia is going to move like $70 for the earning. Is there a way where I can shorten the time frames on this to pull it off?
I don't quite follow your question there. We don't show the in premium terms there.
Okay, so I'm definitely stating it poorly. So I'm seeing the percentages, and obviously we could back calculate it. I was just wondering if there was a nominal value based off Nvidia's current trading price of 940, because I think people just do the percentage movement, and like obviously it's a somewhat of a rudimentary calculation. But I do like this, like the visuals of, and this. Folks, you might be thinking, like, why is this important? Why are we talking about the crush? And to illustrate why, I was streaming on Thursday, February 22nd. Even though it gapped up, half of the questions in my chat were, why did I not make money? I had calls, it gapped up, and it gapped up quite a bit. Folks, the answer to that is right here. This gap, even with calls, people lost money because premium is intrinsic value, extrinsic value. If you're not in the money, you have no intrinsic value. That part is zero. The leftover premium is extrinsic. Well, theta is always working against you. You might get the delta right, the movement right. But if it gets crushed like this, you need to get value somewhere else. So there are folks, don't fall into this trap. Right here, you can be right and yet still somehow lose money because sometimes things are overpriced, they're underpriced, and that's exactly the context of Nvidia versus SMH. Obviously, it's still up to you of the time frame you want to play, but if in the short term, if you're buying calls or puts for this Friday, you're overpaying. It's trading at 130%. It's a little bit different if you're talking a different one because obviously IV changes for the different time frames you're on. And that's why we're looking at it on the bottom here. You have like out into X amount of time. So folks, just to understand the context of how important this is options is a very crazy world where you can somehow be right and still lose money. And that's what we're trying to obviously assist in of helping you guys avoid.
Yeah. And if you just go, look, I got to get long calls into this event because I'm so bullish. You could trade call spread. So you buy a lower strike call and sell a higher one, right? By selling the higher one, you're helping to offset a little bit of that implied volatility drop. Obviously, there's all sorts of other structures you could add as well. And if you look at gamma by strike, just to lay out what strikes are the big ones, 900 has a ton of gamma, 1000 has a massive amount of gamma. So I think that's kind of like, if we get over 1,000, I think we're going to go up to 150. That's how I'm sort of looking at it. But that's the hurdle that Nvidia has to clear, I think, for a real sustained move. We could very well reject off on just sort of a, let's just say an average reaction, or we could see an immediate earnings release news where it hit off 1,000 and come back. I don't think that's terribly bullish, but if we can get up over 1,000, then I think there's more room to run with 1050 kind of up there on deck. And what I'm looking at specifically is that orange line. And that orange line is, you can think of it as momentum. So where that orange line flattens out, that's kind of where momentum dies. and that momentum is, I think, pretty well sustained up into the 1050 area. And then to the downside, 850 downside, where if we go below that, that's oversold in my opinion, and where we'd be looking for an obvious sort of buy the dip situation. And again, just to be clear, this is advice, just so we're looking at this stock. But if you do the math on that, 900 to 1,000 is roughly kind of that 5% range, and then the 850 to 1050 is like the 10% range. So that's what the options market's pricing in, is roughly that 5% move. But I think we could see, my favorite view is a more sustained move up into that 1050
Gotcha.
on a positive reaction.
Very cool. Okay, this is great. Very, very helpful. Before I let you go, folks, we only have a couple more minutes with Brent. He's a very busy guy doing a lot of things. Any quick questions for him that he could quickly just fire off? So if you have any questions, this is your time to let it fire. We have them for a couple more minutes. But folks, with it, like I said, the biggest thing you're going to learn about options is you can be right and somehow still be wrong. And it's things like that with spot gamma. You need to know on a very general basis, are you overpaying or underpaying? Just because something's trading at a value, that doesn't mean historically relative to what the stock has or hasn't done, if you're getting a good deal or not. You can get the movement right and then still be wrong. And if you don't think it happens, that's literally what happened to half my chat on the last stream. So instead of buying those calls, and yes, granted, that time around expectations were a lot more, they're kind of muted now, which maybe sets up a situation for somewhat of a surprise. But you have to know the relative measure. Well, we are so poor we cannot afford to pay attention. That's one way to look at it. Anything specific to this crush? Folks, obviously this is going to stay up. So if you need to rewatch it, I know some of the material could be a little bit dense, but this is exactly what you have to do to be successful in this game. If you're just slinging from the hip, remember you're competing against people who not only know it at this level, but probably know it much more intimately. So are you going to learn it overnight? Absolutely not. But these are the types of things you have to start considering when you're actively trading. This is a marathon, not a sprint. So please understand that.
I would also just add too, even if you don't trade options, by looking at how high or low implied volatility is, you can get a great sense of sentiment, right, in a stock. Because if the implied vol is extremely elevated and there's a giant, what we call call skew, like that chart we showed looks like just a ramp going off the cliff, then you know that there's this bullish over extreme sentiment. And one of the great examples is SLV, the silver, silver's had an incredible run recently. And the calls have gotten so expensive that it's almost like, look, you can't buy this and make money more. And this skew has come down because the silver is down 2-3%. If you just do a quick comparison to 2-3 days ago, if you hit that little 3-star or 3, hit that up there, and then just change the date to Monday, and then choose a 30 days expiration option, so you're doing a apples to apples comparison there.
30 days right here. 32.
Go to the very top quick of that selection chart, because you also selected 0 DTE. Just uncheck the top one. Yeah,
perfect.
And then just hit add. Okay, so that's what the call skew was 2-3 days ago. So you can see how elevated that is above the cone, right? The cone is a statistical average, and there's what we call that call skew, which is the calls have a much higher implied volatility than versus that dip, right? That little low in the chart. And that's just telling you that there's extreme bullishness, and it's gotten to this level that it's hard for stocks to sustain themselves or move to sustain the momentum. Why? Because as the market or stock moves more, market makers and dealers keep expanding the prices, right? It's a function of demand. The more calls that are bought, the more they charge for calls. That makes implied volatility go up. And then at some point, you're just paying so much that those calls are probably never going to get paid out. Ken Griffin is going to be super happy to sell you those extremely expensive calls.
Gotcha. No, this is all like starting to stick, and very, very useful to start tracking these things. And I think a lot of people have these like visions of grandeur. They could come in and they learn like one basic candlestick. Hey, this is a peak, this is a valley, and like you just let it rip. It's not that simple. Can money be made trading? In my humble opinion, yes. Like, you know them, I know them. Yes, there are people who figured out some sort of aspect. It's just not as simple. But also, I don't want anyone to get scared to the point, like, the learning curve is there, but yes, you can get over it. And it's obviously things like this, SpotGam as a whole, that offers a couple more insights into what's actually happened, rather than, I love this thing of just, oh, it looks bullish, it looks bearish. It's like, I don't even know what that means. Like, we're just seeing price go up and down.
Yeah,
And
this gives you the stats, right? And that's probability, and that's what the nice thing is. And I think one of the biggest edges for us retail traders is trading around emotions, right? When things get to be extremes and everyone's excited about GameStop and everyone's super bullish on this name or that name and they're just going crazy. And you could take the other side of the bet, right? And you can do that with defined risk, which is what options offer you. I think that's one of the great paths for success, right? Wait for things to get divergent and extreme, and then you can come in and probabilistically make a trade that's going to work out in your favor, right? And you're never ever going to be 100%, but you can get those odds working for you in your favor when you know that other people are just making decisions that don't make a lot of sense.
Yeah, I think that's absolutely phenomenal input. Well, obviously for me personally, and on behalf of all the chat, we appreciate you taking the time, and obviously shout out to SpotGamma for offering this to retail traders, because to my knowledge, a couple of years ago, this was something that retail didn't even have access to. It was very much in the realm of quote unquote professionals. So shout out to you, shout out to the team. Folks, if you ever have any questions about SpotGamma, the customer service team at the company is helpful. Email them during stream. Feel free to ask me. I'll do my best, but I could at least get you in contact with one of them. But Brent, thank you so much, and we'll see how Nvidia plays out. It's exciting times.
Yeah, thanks so much, Matt. I would just add, we do twice weekly Q&As. We just added my good friend Imran Laka. He's doing office hours now. We got a Discord channel stuff. So there's plenty of help. Come kick the tires. I think you'll get the value of that first month. I think it's a great deal. And Matt, I can't say how much I appreciate having me on today.
Yeah, thank you. Have a good one and best of luck.
Thanks. Take care.
All right, folks, Nvidia in that whole time picking up right now. And man, every time we get on one of those calls and it, like, the things that you could do in the comparison, like right here, I still have up silver to see how, like, it was crazy, taking a little bit of a breather and the whole line's dropping. But in real time, you guys know me from watching this, that I'm addicted to tracking what's going on with Nvidia, and well, Nvidia throughout the day today. But a lot of the times it's just the straight up SPY. And like, even right here, we could see that all this insanity happened. They got the flow alert, all this dump. Then it went flat. And as soon as options pick up, well, surprise, surprise, that's exactly when price picks up. It also looks like they damn near bottom ticked this. The SpotGam implied 1 day move low. It looks like it literally bounced right off of that. That's actually incredible. Look at this pink line. It tapped it and then went. Wow, that's insane. But anyway, these are great conversations, and it's something everyone should understand. So right now, if you are looking at Nvidia, and I don't really care if you're bullish or bearish or whatever it is very difficult when looking at it this Friday, the 24th. You're overpaying for premium. Now, on the flip side, if you're looking for a different expiration date, well, all of a sudden, the farther you go out, you're not paying so much. So the question of, are you overpaying or underpaying for calls or puts? The answer is, it's somewhat dependent on the actual expiration date. And that's exactly why we were having somewhat of a conversation of the ETF SMH, where, okay, you could argue for this Friday, you're overpaying, but not by as much. The Nvidia, it's 140%, while here on SMH, it's only 67. So yeah, you could get a nice move. And once again, when you go farther out in time, you are starting to not overpay. In some of these situations, you're actually underpaying. So with that in mind, whether you're bullish or bearish, I wish you the best of luck. But in terms of, should you be long premium and short premium? Remember, if you're bullish, you could either buy calls, you could do a debit spread, or you could do a put credit spread. And obviously there's many other things, butterflies, broken wing butterflies, ratio spreads, like the list goes on and on. But you get my point of, it's one thing to have a directional bias. It's another thing to know how to play the directional bias. Just because you're bullish doesn't mean it's appropriate to buy calls. Just because you're bullish doesn't mean it's appropriate to sell puts. Sometimes you have to do a little bit more of a deeper dive to understand where there's ways where you could put statistics and odds in your favor of how you execute a certain play. Maybe you're not directional at all and you want to do an iron butterfly. Maybe you want to do an iron condor. That's all these types of things. You need to know where the IV is at and where the prediction of where it might potentially be going. So obviously before on this volatility, on the term structure, this prediction right here, SMH, the idea of after after the report comes out for 5/31, so not this Friday, but next Friday, it's going to get rocked right there. So obviously, directionally, if you're right, if it's in the money, these are all the types of things that are just like the start of what you really need. And these are the things you should focus on, not the furu guru, like just follow my trades. I have a good feeling about this. If you want to be a sustainable trader that like actually knows what's going on and you're not reliant on someone else's BS signals where they're just probably flipping a coin, these are the types of things you need to get into if you want to be a successful options trader. Speaking of which, looks like the SPY's popping, looks like the Qs are popping, Nvidia's popping, SMH is popping. Everything's getting a little bit crazy into close right now. Absolutely bonkers, absolutely wild. We have just under 20 minutes. This is insane. Well, anyway, folks, before I let you go, I just want to let you know that right here, Spot Gamma, I have two different thoughts. Spot Gamma, currently $49 a month. I think that's phenomenal. It's 80% off. To my understanding, they've never done a deal like this before. It is pinned to the top of chat. It is in the description of the video for those of you who are interested. This is normally $250. I fully understand there's a psychological jaw-dropping factor when you hear $250 a month. But please understand, if you saw my stream this morning, off of Spot Gamma, I made $350. I would implore all of you to think of this as a business. Does it offer enough value that is more than its own cost? So for example, if you sign up for Spot Gamma right now, 80% off, $49, the question is, can you utilize it enough to make more than $49? Does it provide $49 or more dollars worth of value? Yes. In my opinion, the way I use it, the way you all could use it, it's a phenomenal tool suite. Excuse me. They do multiple Q&As and they are obviously very supportive of the retail community to bring you up to their level of knowledge is probably the best way I could pitch it. So whether you're talking about the $49 a month, $249, in my humble opinion, as soon as you really dedicate some time of your own life to understand how to use it, I think it's worth way more than that. But anyway, they understand as a team that $249 at first can really seem steep to a lot of people, because it is. Obviously, we want to be respectful that times financially are like not the easiest thing. And that's exactly why they're doing 80% off, to put their money where their mouth is, to prove it to all of you that they can actually provide that much value. But just so you guys know, the deal is only for another 2 days. So if you want to lock in this 80% off deal, once again, you have 2 days and 8 hours pinned to the top of chat in the description of the video. As we're seeing Nvidia rip, as we're seeing SPY, Qs, everything's bouncing back a little bit. Absolutely crazy. Absolutely crazy. Well, anyway, folks, I do appreciate your time. I'm going to go hop in the Discord and figure out what plays I should personally make before the bell concludes today, and see if I could take advantage of some of the knowledge that Brent just dropped on all of us. Maybe I'll play SMH. Maybe I'll play Nvidia. Maybe I'll play the two of them. Gotta look at the tool and tell me which is smart, quote unquote smart, and obviously just trying to put some of the odds at my back. I do appreciate you guys stopping by and joining me in the Specialty Power Hour show. Thank you, thank you, thank you. That's what I have for you. Heading over to the Discord. I hope to see you there. And by the way, you could join the Discord for free. When you sign up, it's all in the description. Just make sure you use the code Goonies. But I got to go make some trades. That's what I have for you. Thank you so much. Peace out.